Good afternoon and welcome to our session, Anatomy of a Business Case, Integrating Business Discipline into Law Firm Strategy. Our goal is to illustrate the significant gulf between how law firms approach strategic investment today and how they could approach such decisions if they embraced multiple new business disciplines. Rather than approach these disciplines in isolation, however, we're going to talk about how they can be integrated and work together. After all, it'd be a travesty if we missed an opportunity to grow market share in troubled times. Before we get started, I'd like to introduce our participants. I'm Tim Corcoran. Joining me is Alman MacDonagh, also Purvi Sanghvi, and Keith Maziarek. To illustrate these concepts, we will role-play three separate scenarios. One to showcase a somewhat exaggerated view of how law firms approach strategic decisions in the past. The next will examine how a business employs a far more rigorous approach. And the last will illustrate how a law firm can adopt some of this rigor to make better decisions. Our takeaways today, a couple key points. Sound business decisions require analytics. We analyze multiple independent and interrelated factors before we make decisions. We measure performance over time, and we compare alternatives, including doing nothing. With that, let's get started. In this first scenario, Kath will play a top rainmaker who wields a lot of influence. Purvi will play our managing partner. Keith will play our chief marketing officer, and I'll be our chief operating officer.
Yeah, thanks. I'll be in touch. Thank you so much. Okay, sorry we're starting late. I had a really important phone call.
Hopefully getting us more business.
Oh, of course. Okay, so I wanted us to talk about this great opportunity we have. A guy I know who's a partner at a big firm across town wants to move to DC, and he wants to take his team with him. And his firm doesn't have a DC office, so he wants to explore his options.
We don't have a DC office either.
Right, but now we could, building it around this guy. He's got a solid $8 million in business that is fully transportable. I've already talked to the guy, and he says he can double his business in 4 years. I say we do it. It's the perfect chance to get a foothold in DC, and that's something we've been talking about for a long time.
Well, that sounds promising.
Well, I don't recall us talking about DC at all. It's an expensive market and there's a high cost to entry.
Oh, he's already looked at the perfect place, right on K Street. It's not too expensive. Plus, we've got plenty of money. We can afford it.
We don't really have much of a client base in DC. Why does he want to relocate there anyway? Are his clients there?
Well, his kid's going to Georgetown in the fall, and his wife wants to stay close, but that's not what's important. Most of his clients are on the West Coast anyway.
Oh, so we'd be looking at some decent travel costs too, huh?
Oh, he never visits his clients. Why should he have to? We're all virtual nowadays anyway. With email and video conferencing, we can work from anywhere.
Oh, so add some technology costs.
What's that?
Oh, nothing.
So what kind of work does this guy do?
Well, he does general corporate work, something we don't do too much of. So this is a great opportunity to cross-sell our other clients.
Well, have you seen the numbers?
Well, actually, no. He's talking to a bunch of other firms, and he isn't keen on sharing too many of the specifics right now. He's looking for our best offer. But did you hear the part about growing to $15 million in 2 years?
Well, do we even know that he does work that our current clients even need or want from us? Do we have a client list we could see? And what about conflicts?
He's a great guy. He gets along with everyone. Oh, you mean those types of conflicts. Well, we'll probably have a few like always. Clients come and clients go, am I right?
Well, we've not had a good track record on laterals. We spent a lot of money to bring them in, and most of the time they never hit the goals that were set for them at the beginning.
Well, this guy makes a lot of money. His billing rate would put him as one of our highest rate partners in the firm, and that will definitely help.
Well, that won't help cross-sell into our clients, though, especially if he wants to increase his rate to the top of the market in DC.
Well, we're not bringing him into cross-sell.
So how does he plan to grow his book of business, then?
Leverage. He's got a top-notch team, an experienced partner, 2 associates, a paralegal. And we have plenty of associates we can use. Oh, and he has to bring his own secretary.
Well, secretaries are important. Couldn't live without mine.
Well, and the sort of work he does is a very hot area right now. All of my friends and clients tell me how hot it is. So we've got to really get out and help market these guys. Keith, our marketing is terrible. We need to give these guys as much support as we can. They want to advertise, and they have a bunch of ideas about sponsorships in a couple of big trade groups. And they want to hold a big client symposium in a fancy hotel sometime in the next 6 months or so.
Okay, well, we'll definitely have to discuss that. But we haven't had much success in growing our own practices using those methods.
Well, that's because our guys are a bunch of doofuses who don't know what they're doing. And, like I said, our marketing is terrible. That website, don't even get me started. I can't find anything on it.
Well, let's get back to the numbers. Any idea of how profitable this group is? We like to keep our profit margin above 30%. Any idea of realization? Are we talking mid-80s maybe?
Well, we don't have any firm numbers on all that, but the guys promised that after our first year, we will be seeing big profits and realization rates in the 90s.
Well, that sounds great, but has anybody checked on this? I mean, done any research? We could start pulling some research and do some analysis now.
We don't have any time for that. If we lose this guy, our clients are going to be ticked that we missed this opportunity. Once again, we'll be left behind by our fast-moving competitors.
Well, what kind of compensation arrangement are they looking for?
Well, lead guy and service partner would both come in at equity status, along with a 3-year baseline lock on their comp, with incentive bonuses in addition to a minimum bonus. Then there are the associates, both of whom who would be looking to become partners in a couple of years, of course. They are also looking for some decent comp guarantees. I think we have to do that. We wouldn't want to lose them, because without them, this guy won't come.
Well, we can probably handle the comp issues. We've done this before.
Yeah, but we've also had some issues on that front with other laterals, and our partners aren't too happy offering guarantees to new guys who haven't yet contributed to the firm.
Maybe, but other laterals have always added to the top line revenue, right? And that's what's most important around here.
Well, hold on a second. Do we have any idea on timing as far as when these guys want to start?
Well, that's an interesting thing. Actually, we've already made some verbal offers to the partners, and we anticipate they'll accept and give notice by the end of the week.
So this is a done deal?
Well, not entirely, but we're close. The executive committee has signed off on everything. We'll push through a partnership vote by next week.
These guys want to start a week from Monday. Their current firm won't keep them, so then they've never done that with any other laterals. So we'll need to get the office ready, business cards, stationery, computers, phones, the works. And we'll need to make a big splash in the press. So they want to see a draft release tomorrow morning. So you can get them some interviews and get a bunch of stories written about our new DC office and these guys' arrival there.
Okay, I think that about covers it. I gotta go to a lunch. Any questions?
Well, thanks, everybody. I've got a call to make, and this is going to be great.
Sure.
Well, law firms don't always act in their best interest when they're not using data to inform their decisions. So in this next act, we can imagine business leaders take a much different approach when analyzing investment opportunities. Successful companies employ a formal and disciplined process. They analyze both internal and external data. They make decisions based on a comparison of alternatives, including not acting. So let's observe one such corporate boardroom in action. In this scene, senior executives are preparing for a presentation to the parent company executives at which they're competing with colleagues in other divisions for a limited pool of capital investment. In this act, Purvi will play our CEO, Kath will play our Chief Marketing Officer, Keith will play our CFO, and I'll be the VP of Product Management.
Thanks for gathering for the dress rehearsal. We've done our homework, so let's not waste any time. Tim, as VP of Product Development, kick us off.
Thanks, Purvi. So we're proposing an investment to develop and launch a new software offering in our existing markets, but in an area adjacent to our existing offerings. We've reached this conclusion after reviewing numerous other proposals and after conducting a build versus buy assessment. Our best option is to develop this software internally, as it will increase our speed to market. And this will provide first mover advantage for a growing unmet need in our native markets. Our goal is to become the market leader, the reference brand by which all other products are compared.
We seek $3.8 million in capital spread over 2 years. The investment results in a positive NPV with an IRR of 40% using a 12% discount rate. The investment reaches break even in 3.5 years, and margin is accretive by year 4.
The unmet need was identified through quantitative and qualitative market research and represents a growth opportunity for a number of years. There's no entrenched competition to speak of, and the predominant solution used by the target customers is some combination of homegrown software or manual processes, both expensive and difficult to maintain. We can add significant value and reduce the customer's current costs while rapidly capturing market share.
We believe a standard software revenue model will apply here, with license purchases upfront, followed by multiple years of maintenance revenue, and we've built in reasonable price increases while also incorporating reasonable annual attrition. We project renewal rates ranging from 80 to 90%. We anticipate our competitors will launch a competing offer by year 3, so our growth will eventually slow down.
We've identified 3 specific offerings, a low, medium, and high-end version with escalating price points and functionalities. The high-end offering will generate services revenue from customization and configuration. The other 2 will be off-the-shelf options designed for customers with limited resources and limited needs.
We conducted conjoint analysis and several focus groups to identify the right combinations of features, functions, and price. And our 3 price points address 3 key variables: speed to market, or in other words, a low price point designed to move units quickly; market comparatives, allowing us to easily demonstrate that our solution saves customers money; and a healthy margin based on our cost of goods sold. Our analysis shows that our low-end offering could be sold on a higher price point, but this would slow sales and decrease adoption rates. Gaining share quickly is much more lucrative in the long run than maximizing short-term revenue.
So we've decided to develop this internally using a combination of dedicated and shared resources, most of whom can be redeployed from other projects. Over time, we'll limit the dedicated resources as development and support are moved into our mainstream workflow. By corporate mandate, we'll use the parent company's hosting environment and technology platform, which does add some cost, but it also reduces our risk as we benefit from existing investments in bandwidth, security, data protection, and disaster recovery scenarios.
We'll sell the product primarily through our existing direct sales team, though we'll add some product specialists to support the effort. This will involve some retraining and additional incentive compensation, but we've worked with sales leadership to build this into the sales motion. For the 2 lower-end offerings, we'll also rely on channel partners to sell into other vertical markets, particularly those where we expect minimal demand customization. Our margin is lower on these units, but we bear none of the go-to market costs. In our own markets, we've observed a significant gap in thought leadership for this new space. So we've teed up an integrated campaign of social and traditional media to create visibility and generate leads.
Over time, we'll add an account management function for ongoing customer support, and we'll rely on the shared customer call center for primary and secondary technical support. These are mostly self-funding, as we only add resources when the product revenue is sufficient to support them.
In summary, the investment addresses a clear unmet need. We can develop and deliver a new offering at an accretive margin by relying primarily on existing resources. By focusing initially on capturing low-end market share, we pave the way for more profitable and stickier high-end offerings. And we're cash flow positive in 3.5 years. For these reasons, we believe this request for capital investment of $3.8 million will deliver a greater return than other options available to executive leadership.
Well done, team. If this was my money, I'd invest. Fist bumps! Woohoo! Yes!
So for some of us, the corporate business case looks unrealistic because we don't have nearly enough data. For others, we don't have an organizational structure that could foster such a collaborative discussion. And for still others, we may as well have been speaking Greek. So our central theme today is that we can do a better job making strategic decisions in our law firms. We don't have to run a law firm exactly like a business, but we can certainly adapt and incorporate more rigor into our process. We must examine numerous data points, relying on internal and external sources, balancing our financial goals and our resource mix against what the market demands, what the market is willing to pay, and what the competitors are offering. And this is not easy, but we don't have to be perfect. We can start by doing a better job than we do today. So let's watch as a modern law firm tackles these concepts. In this scenario, Keith will play our Chief Financial Officer, Purvi will play our Chief Marketing Officer, I'll play our Managing Partner, and Kath will play our Director of Practice Innovation, which includes pricing, process improvement, and project management. Okay, team, let's get started. As you know, I've called today's meeting because we've got a choice to make. One of our top rainmakers is proposing that we recruit a well-known partner from another firm, along with his team, and relocate him and his book of business to a new office in Washington, D.C., where we hope he'll begin generating significant returns.
Let's walk through these adjustments. In our experience, laterals tend to bring in only 75% of their current book with them, so we've reflected that. Plus, every book of business creates some conflicts. Either some of the new clients can't come or some of our existing clients can't stay. We can't yet know the full impact, of course, but in our research, we were able to identify some key clients that helped us make some preliminary adjustments for the lost revenue.
We also did some behind-the-scenes research and learned that this lateral partner has almost no impact on cross-selling in his firm today. His team neither exports nor imports work from other practices, so their performance is best examined in isolation. While our firm's culture is far more conducive to cross-selling, we've dialed back our expectations that we can cross-sell to his clients or that he'll take the time to cross-sell to ours.
We benchmarked the laterals practice against industry trends and learned that the service offerings are priced well above market, and there's significant price pressure and strong client demand for AFAs. Since we understand this partner doesn't do AFAs because it compromises the quality of the legal work, we've adjusted our growth expectations. This practice will not grow, and AFAs will increase whether he likes it or not. The compensation guarantees we'd have to take on will limit our ability to adjust our service delivery and staffing models, so this practice will likely become dilutive quickly.
Well, I see that we've also reflected more realistic relocation and office build costs, and we've allocated the entire cost of the new DC office to this practice. In my informal poll of other partners, it was clear no one wanted to subsidize an office we don't want for a practice we don't yet have in a region where few of our existing clients have needs.
The net effect is that our earlier rosy picture of a healthy, growing, profitable $8 million book of business is replaced with a far less compelling view of a practice that will decline rapidly in a competitive market unless we make significant adjustments. The data supporting these conclusions are readily available, so either the other law firms competing with us to recruit this lateral are misguided, or they're purposely bidding up the price so whoever does win already starts off in a tough position.
Well, Purvi, this is a noble profession, not a cutthroat business, so we know our competitors don't want to harm us. So let's assume they're just misguided and haven't conducted a similar thorough analysis. So let's walk through the alternative.
Well, when we look at a snapshot of the IP practice, it's not all that compelling, even when we look at it over a few years. This is, of course, why the partners are pushing us to divest the practice, or at least to de-equitize under the underperforming partners in the practice. But when we dug deeper, we found some real opportunities to grow this business.
We analyzed market trends and learned that a couple IP services have rapidly growing demand, but clients aren't willing to pay for a lot, so many law firms are either overpriced or simply not offering the service except as an occasional loss leader. We also see an increase in high-end litigation. It's just that we don't get a lot of at-bats to win this work. We factored in this growth potential into our projections.
We've talked to a number of clients and done independent research and learned a few things. There are a few barriers to entry to do this work. It isn't rocket science, but it does take specialization that we have or can obtain quickly. There is minimal loyalty for routine services, suggesting we can win work away from current providers. And if we price and staff this work properly, we can actually generate profits rather than treat it as a loss leader. And by taking on the routine, non-glamorous work, we'll have a much better chance of clients considering us for the high-end work for which we can bill our premium rates.
Well, as we know, we can't possibly offer profitable AFAs without also addressing the delivery of the work. And these service offerings are ideal candidates for the new process improvement and project management approaches we've begun to deploy. This allows us to keep the price point low and make a good profit.
After an upfront investment to really embed and operationalize the PI/PM mindset, we can actually lower our fees for these offerings over time while maintaining or even improving our margins. This continuous improvement mindset is really the engine that drives our profits long term. Plus, as our clients have told us numerous times in the past, the ability to break down and properly budget matters is a great demonstration of expertise. After an upfront investment to really embed and operationalize the PI/PM mindset, we can actually lower our fees for these offerings over time while maintaining or even improving our margins. This continuous improvement mindset is really the engine that drives our profits long term. Plus, as our clients have told us numerous times in the past, the ability to break down and properly budget for matters is a greater demonstration of expertise than merely lowering our rates.
We've already talked to several clients, and they're enthusiastic about collaborating with us to tackle the process improvements and project management aspects of this work. We can simultaneously improve how we deliver the work and demonstrate to clients firsthand how seriously we take continuous improvement. We plan to invite our clients' procurement professionals to participate as well, so together we can develop a scorecard that they can use to measure us and their outside counsel.
We've adjusted our growth expectations based on winning more of the routine work and getting more opportunities for the high-end work. Based on the client interviews Tim and I conduct, this continuous improvement approach will really strike a chord with in-house counsel and procurement. They're always looking to measure us on factors other than price, such as predictability and throughput, or to have us recommend new ways to measure performance and quality. Meeting these needs is a proven way for us to raise our net promoter scores, and success will breed more success.
The more success we have, the more resources we'll need. The good news is our staffing model pushes this work to the lowest cost resource that's capable of doing the task. So we don't compromise quality even as we reduce our cost of delivery.
And as we grow, we may need to add additional resources, but these won't need to be expensive lateral partners. Rather, we can utilize associates and paraprofessionals. Furthermore, with more precise project plans, we can adjust staffing levels based on better forecasting than demand, and we can avoid incurring significant carrying costs for idle resources.
Well, this ties nicely with our need to generate work for underutilized timekeepers elsewhere, which I know is a constant demand on Purvi's marketing team. The nature of this work allows us to tap existing resources, which are sunk costs already borne by the firm, so timekeepers from general commercial litigators to paralegals can be brought in as needed.
Exactly. Rather than chasing every RFP and pursuing random acts of marketing just to keep idle partners busy, I'd rather have my marketing and business development team spend its time developing a thought leadership profile for the firm in this growing area. Our research shows none of our competitors own this space, so we have an opportunity to create significant visibility, demonstrate our expertise, and carve out a new niche. We have a blueprint for an integrated campaign of social media, traditional PR, plus writing and speaking engagements, some of which may start as pay-to-play, but over time, our expertise will generate plenty of speaking invitations without sponsorships. We've even identified a few clients who may help us place some partners into influential roles within industry associations.
The net effect is that we can grow this practice, and by using both strategic pricing and process improvement and project management techniques, we can deliver the services profitably. This approach gives us a sustainable cost advantage, so we can shift market share while our competitors will assume we're engaged in suicide pricing.
We can improve utilization and leverage by staffing the work differently, and we'll win more opportunities to bid on the premium work. And once our clients see our focus on efficiency and predictability, even when we bill hourly at premium rates, we expect our win rate to jump.
And we can improve client satisfaction, which leads to higher retention rates and cross-selling. And frankly, between us, those are exactly the factors which turn clients into firm clients. It reduces our risk when one of our rainmakers leaves or threatens to leave. Okay, sounds like we're in agreement. We decline the opportunity to recruit the lateral partner, and we direct our investment to the IP practice. Good job, team. So our goal today was to demonstrate that a law firm could actually embrace these business disciplines, incorporating them into the process they use to analyze different investments, and do so in an integrated fashion across multiple functions within the firm. And the information available to us today helps us inform these decisions. There's a lot of providers that provide services and tools and data to the marketplace today, which we could use to inform our decisions. So to reiterate our takeaways, sound business decisions are based on analysis, not knee-jerk reactions. We must analyze independent and interrelated variables to see if our future state is better than we are today. Performance is best measured over time, not at this very moment, but over a series of years will we have a better situation than we are today. And finally, we must compare alternatives. Sometimes it's better not to take action. Sometimes there are several actions that are all good, but one is going to be better. So we compare those alternatives. Hopefully today we've conveyed that a law firm could embrace these concepts, and we hope you enjoyed the presentation.
Let's see what questions we have to this point. So for those who might not have heard, we try to use the data we have and we benchmark it against others. The example of 75% of the laterals book of business is all we get typically. Do we know the number? We should be able to know the number, right? It's not that hard to figure out. If we look at the laterals we've recruited in recent years and we look at what is their book of business 1 year, 2 years, 3 years, 5 years out, does it match the expectations? This isn't an exercise designed to punish the lateral so much as to say, is our radar good? Are we good at this? Because when you're investing in something, you have optimism. You have to have optimism. And so leaders often have false optimism. They want it to work. We're going to be that firm where this entire book of business comes over. Or we're going to be that firm that our brand is so special that we'll be able to charge premium rates, even though all of the benchmarking we did show that the rates are declining for every other competitor, right? Optimism is a good thing. But when we temper it with data, we can try to dial back our optimism to more realistic. And that's the states of nature. I didn't call that out specifically, but in most business cases, you have a realistic, you have an optimistic, and you have a pessimistic view, right? You don't typically have one view. You have a couple views. We called it likely here, likely or realistic. And so it's okay to have optimism and say, you know what, if this works, and everything works perfectly. If we hit all the green lights on the way to work because we got out of bed late, I'll get there on time. But the likely case is we're going to hit a couple red lights, right? So which of our areas that we're studying are we more likely to face a challenge in and develop a more realistic case? Good point, good comment. Yes, sure. So how would this differ if we're looking at a different type of investment? So that's the beauty of this investment kind of math. You build a spreadsheet and you try to look at your revenues and what are the variables to influence that, and then you look at the cost it will take to generate those revenues. And that structure you look at over a multi-year period, and if you do it well, you can reduce it down to a net present value, a single number that shows today what is the value of all of those years of analysis. Now that analysis, that process, that framework works no matter what we're looking at. Whether or not we're investing in an event, or we're opening up a DC office, or we're recruiting a lateral partner, the framework is the same. If we do this, it will cost us some money. But if that money generates some revenues, what will those revenues be and why? And what are the variables that we have to tweak to reflect what those revenues are realistically going to be, even though we know that we could maximize all hours, so the lateral will have 100% of his time booked, and 100% of his time billed, and 100% of his time will be paid by the clients. Well, that's the max, but it's unlikely, so how do we dial that stuff back? So the framework is a very simple framework, and I'm happy to send these slides to folks who want to look at these in more detail, but that can apply to multiple different areas. The notion of ROI is really taking a look at what we have to spend to generate the revenues, what are the likely revenues, and what are the variables that will influence those, and then let's dial back to more realistic expectations, and then compare it to the alternatives. Good comment. Other thoughts?
Well, I guess for me, if you're talking about, you raise the issue of an event or something and try to determine ROI. It's difficult if it's a new event, but what I try to do with our firm is if we have a history of having, a few years of having done it, it actually allows you to have a good conversation the next year and say, you know what, we did everything we could to leverage that event. We did all of the pre-work, we did the follow-up, and we really did not see that it was worthy of the money that we spent on it. So I would say people in law firms need to do that. Don't just get on that bandwagon of, well, we do it every year, so let's do it next year. You just have to analyze those sorts of things, because we're talking about thousands and thousands of dollars, and I can't even talk about, we all know the man hours, the man and woman hours that we spend staffing those events. When you're talking about something that is an event or something that you've not been involved in, it's a guess. It's a guess. I mean, you can do the best you can to compare it to something that you may have done, but that's more difficult to really make a decision about, and sometimes you just leap into it. But the next year, you're able to actually do a little analysis.
And building off that, having budgets. I just came into a law firm recently and there weren't budgets. You just spent what they spent on an event, and one event's entering, I think it's 9th year, and I asked, what's the budget? And there's whatever is spent. Oh, that's fun. But that then gives you a sense of responsibility and ownership of it from the marketing perspective and from the practice area that is involved. And in this case, it's a lot of practice areas. So, for every firm's in a different place, and this is a baby step, but it's an important step, so they understand. I mean, that's going back to your question of business development. How do you do an initiative? Show them that this one worked on this budget or not.
I would just say I'm in a boutique firm, so I'm in a little bit of a different situation than my friends up here. And my firm, it's a little easier. Most of the partners are involved in our events. We have 21 partners, so they know a lot about what we're doing. They have their own opinions about the value. which I hear about very directly, but for the most part, it's a little bit easier. Also, I get a lot of support from our COO. We have an actual brand new COO who's been at our firm for about 2 months. He, like our prior COO, has a very strong financial background. He likes benchmarking, he likes numbers, he likes statistical analysis. Frankly, it makes my life a lot easier because he supports these things or says to me on the side, hey, let's take another look at this, or maybe we can shave this down, or let's make a shift. So that's really helpful for me.
So the key for me is to have a process so that we don't have a budget and try to kill a project we know is a bad idea. So we're going to develop a budget or develop a business case to show that it's a bad idea. We have a business case or a budget, or we have a process to analyze everything we're doing, even those that we know are going well. That gives us credibility when we have a simple framework that's applied all the time to the things we do, and then when one doesn't measure up, we can say, we're not picking on you. It's simply not showing up as something that would be a worthy investment. Another takeaway is that our job is to inform decisions. The business leaders will make decisions. So a lot of times when I have this conversation or something very similar to it with law firm leaders, they will choose to make a decision that is not the ideal economic decision for them. And there's nothing wrong with that. We all have practice groups that are perhaps legacy groups that we continue to have, even though they're not generating as much profits as some of our big ones. We all have partners that are not as productive as they once were. We all have staff people that we work with that are not as productive. We could probably get more productivity out of someone else. It's okay to solve for other things other than profit. Our job is to inform those decisions. We want our leaders to have all the facts at their disposal, so when they make a decision, they make a conscious choice. Even if it's not the ideal choice, they're making a conscious choice. And so there's no emotion in numbers. The numbers simply say what they say. And of course, you could play games with the numbers, but if you have a good framework, it helps insulate you from gaming because the numbers are all transparent. But the idea is our job is to inform. The data says this. If we choose to take a different course of action, that's okay. That's what our business leaders, that's what our law firm leaders should do. They should make the decisions they think are in the best interest of the firm. But if we can inform that, we'll make better decisions over time. And I think what the final takeaway is that we are seeing a shift in our leaders in our law firms. First, obviously, at the overall firm level, where the managing partners and chairmen and chairwomen have to really have a grasp of the financials and not just the daily cash flow receipts, but understand how we're running this business. And that is slowly, but surely moving down to the practice group leader level, who are the people making decisions on a day-to-day basis in the battlefield with zero training, and they're expected to keep an entire book of business. It's a part-time job for them. Yep, they're making calls that could resonate to the tune of millions of dollars. So this business training, you don't have to be an MBA, but you have to have smart people around you who can help inform those analyses. Good comment. Other thoughts, closing thoughts? Anyone ready to get a financial calculator and go back to B school? We got into marketing because we didn't want to do math, right?
Right, pretty much.
It doesn't have to be hard. The concepts are pretty simple. You and I and everyone in this room could be collaborating with our financial colleagues. They can do the analysis in the spreadsheets. We can help provide the data. We can point them to the right information. And then collectively, we can analyze it together. Everyone in this room is capable of looking at a spreadsheet, or at least the elements that come out of a spreadsheet, and say, which investment is better? Which is more realistic? Does this have credibility, this business case we're looking at? So we all have the ability to sit in a room and analyze the output of those, even if we don't have the capability of building the spreadsheets, and that's okay. That's where I think one of our first points. We have to do this together. Right? We have to be best friends with our colleagues in other disciplines, our librarian folks and our IT folks who can capture information from tools internally and externally, our finance folks. Together, we can be a pretty formidable team within our law firms informing our business leaders' decisions. Doing it alone, pretty daunting. Closing thoughts, ladies?
This was fun.
We hope this was educational, perhaps a little bit corny. I do want to give a little bit of props, a very little bit of props to John Byrne for helping to write this a year ago.
Yes.
It's right there.
Thanks, John.
If the grammar is correct, that's because John helped. With that, we will come to a close. Thank you so much for your participation and time.